Welcome back. So we start with our session. The next session is on Decoding IND AS 116, Key Concepts and Practical Applications. And speaker for our session is CA Shashi Tadwalkar. Our speaker is qualified chartered accountant with more than 20 years of experience in audit and advisory services. He's an audit partner in Walker and Chandiok and Company LLP at Pune office of the firm. He has extensive experience of conducting audits under IND AS, IFRS of multinational and entrepreneurial Indian companies. He has advised clients on complex accounting and reporting issues arising in IPO, gap conversion, fundraising, due diligence, business valuation, and purchase price allocation, restructuring, etc. He has also advised clients on establishing and improving finance function, process and controls, enabling automation, leveraging technology. He has diversified experience industry-wise, including energy, infrastructure, real estate, software, technology, consumer products, etc. With this, I'll request our coordinator, Amrita, to present a memo to our speaker. I'll request our speaker to take up the session.
Good afternoon. Yeah, I expected that. Once again, good afternoon. So this is nothing better than a graveyard shift is the post-lunch session. Probably a concept like lease accounting, completely different, relatively new still, probably the last or the newest standard from issuance perspective. One thing which I can promise you, if you fall asleep, I won't wake you up. So, okay. Maybe just go a little bit in the history of the standard itself. Why this standard? Okay. So if you look back at IND AS 17, the way in which IND AS 17 actually made life much easier, right? There were only two concepts: operating lease, finance lease. Operating lease, you recognize the rent expense ratably equally over the lease term, whereas a finance lease would obviously mean that the lease comes on the balance sheet. I don't know what exactly happened and why the standard setters decided to make life more complex for both the corporates as well as the auditors, and that's the reason why this particular standard was introduced. If you actually look at and probably that's the purpose with which I put in some of the assets that are typically subjected to lease as a cover image. This is an AI generated image, by the way, is aircrafts, for example. Okay, if you compare two companies, two airline companies, for example, they may have completely different leasing arrangements or completely different asset acquisition arrangements. There could be an airline company which is extremely well funded, which is buying the aircraft upfront. There is a company which is buying, which is renting aircrafts, but they are renting it for short duration, which are cancelable period, and therefore it gets classified as an operating lease. And there could be a company which is renting an aircraft for either substantially whole of the economic life of the product or for the value which is covering the fair value. Now, the way in which in all the three scenarios the asset actually get recognized or the expense got recognized in P&L was completely different. In first case, where it's a purchased asset, it got capitalized. The amortization hits your P&L basically below EBITDA. That's the first criteria. Second case, where it is a short-term duration operating lease, the lease gets recognized, no asset on the balance sheet, lease expense above EBITDA because it is part of operating lease arrangement. And in third case, where it is a finance lease, again the asset comes back on the balance sheet. Again the asset depreciation below EBITDA, interest expense again below EBITDA. While in all three cases, P&L probably will have impact, maybe varying impact as well. But when you are comparing the three balance sheets, they are not at all comparable. And that's the reason why maybe the standard setters thought that instead of allowing multiple different models of allowing the asset to be recognized on the balance sheet and the expense that is recognized hitting appropriate, because typically, and in today's modern day world more so common, where EBITDA is considered closer to demonstrating the cash flow capabilities of the company. Therefore, let's introduce a single model for lease accounting, which is actually reflecting the economic substance of the transaction. And that's the reason why the standard was introduced, which basically brings in all the assets and the liabilities under lease on the balance sheet. So there is no secondary option, except for maybe there are two cases where it's a small value items and short-term leases. Asset comes on the balance sheet, corresponding amount gets presented as a liability, and in profit and loss, instead of the lease expense being recognized above EBITDA, this lease expense basically gets recognized as amortization expense, and the finance cost also will get recognized as finance cost, which both items are below EBITDA. That's the basic fundamental change in the standard. Okay, if you, so long as you understand this, probably the standard becomes very, very clear to you. So what exactly is the standard? What exactly the standard requires us to do? So this is essentially what I've done is I've actually bifurcated the definition of a lease into 4 buckets, and my entire presentation effectively will cover these 4 buckets. There are a lot of practical examples for you to understand, hopefully to keep you awake. Again, I reiterate, promise, I won't wake you up. So the standard actually requires that at the inception of a contract, an entity shall assess whether the contract is or contains lease. Okay, so it need not necessarily be a leasing contract only. You would at inception need to assess whether the arrangement, any arrangement for acquiring asset, is it a leasing arrangement or not. Okay, which are those contracts which are likely to have a lease component? Where there is a right to control the use of an identified asset for a period of time in exchange for a consideration. So there are 4 key elements. There is a right to control the use of an asset. The asset needs to be an identified asset, a specified asset. There has to be a term over which this lease is recognized, and that has to be, it can't be a free of cost transaction, it has to be a transaction for a consideration. Now let's look at each of these 4 buckets one by one, and what we'll do is we'll cover a lot of practical experiences on what gets classified in under each clauses. We'll probably learn some of the nuances. There are few additional aspects that I will cover, I'll try to touch upon, and there are few aspects which I am not covering as part of the session. For example, presentation disclosure is something specifically I'm not covering. Happy to take up that as a question. Fairly long presentation, so I'll probably try and moderate my speed, but in case if I'm going too fast, too slow, please let me know. Happy to change my speed accordingly. So what is an identified asset and why it should be there? So what the standard requires is, as part of a contractual arrangement, do you really have an asset which is either explicitly or implicitly specified in the arrangement? Okay, if the asset is explicitly or simplified, explicitly or implicitly not specified in the arrangement, then there is no identified asset, and therefore there is no leasing arrangement. So there has to be an identified asset. There has to be a specific asset which in the contract either is specified saying that I'm renting this specific laptop, or there has to be an arrangement which implies that I'm renting this particular laptop. Then only it will classify. The second, if the asset has been explicitly or implicitly specified, the second step that you evaluate under the standard is the asset physically distinct, or the customer has a right to receive substantially all the capacity of the asset. So one, the physical form of the asset has to be distinct, and we'll probably look at some of the examples where the asset may not be physically distinct. For example, if there is let's say there is a lease line, okay, and a lease line is shared by say 10 companies, and each company has been guaranteed saying that they'll get say 10% share in that lease line, you won't be able to distinguish saying that which 10% belongs to you, and therefore it may not be a distinct element within the asset, right? So first the asset has to be physically distinct, or the customer will need to have substantial. So in the same example, if there is a lease line and its lease line is dedicated, let's say, to a single customer, and customer gets entire output generated by that lease line, in that case that lease line can actually become an identified asset where a customer has a right to receive substantially all the capacity of that particular asset. That's the second step. Now, the third step is whether the supplier has substantive substitution right. So if there is an asset which has been identified, if the customer is able to enjoy entire benefit arising from that asset, but if that asset can be replaced, so let's say that I do a car rental and I have done a car rental agreement that I need to have a car available with me for next 12 months or next, let's say, 3 years, and the car has been specified in the contract that I need to have, let's say, an E-Class E220 Mercedes for my purposes, but it can be any E-Class Mercedes 220. Then the supplier has a substitution right. So in case if this car breaks down, he can actually give another asset, then it may not qualify as a lease. If you can replace the asset with another asset, maybe of similar nature, dissimilar nature. For example, in the same example, if it's a contract for a luxury car, it can be a Mercedes, it can be a BMW, or it can be anything, then there is a right available with the supplier to substitute that asset. Then it may not meet the definition of an identified asset. If these conditions are met, then in that case the asset becomes an identified asset, right? If the supplier has a substitution right, then it will not be an identified asset. Let's look at some examples, and I already have the answers because I knew this is going to be a post-lunch session, so I'm not expecting you to answer. Okay? Yes, please. So there is no concept of operating or a finance lease anymore. Okay, the contract will not fall under IND AS 116 if there is no identified asset. Okay, and therefore the guidance under IND AS 116 will not apply. So for example, again the same example, I am hiring a car, and the car can be substituted, and therefore it does not meet the definition of an asset. The payment that is made for that particular purpose will not require all the requirements under leasing standard. That will be a rental agreement. It will not be classified as a lease contract under IND AS 116. Okay. Let's take an example where asset is implicitly specified. Okay. A customer enters into a 5-year contract with a supplier for the use of belt conveyor specifically designed for the customer. The belt conveyor is designed to move the materials used in customer's production process and is not suitable for use by any other customer. The belt conveyor is not explicitly specified in the contract, but the supplier owns only one belt conveyor, and that is suitable for the customer's use. If the belt conveyor does not operate properly, the contract requires the supplier to repair or replace the belt conveyor. The supplier, in effect, does not have a substitution right. So therefore, in this case, the belt conveyor becomes an identified asset, because while the contract is for only supply of materials, for movement of material, but in effect, the arrangement is for renting of the belt conveyor. While the belt conveyor is not explicitly specified in the agreement, in the contract, for example, the serial number of the belt, which make, which, etc., has not been specified. It is implied in the specified arrangement, and therefore that asset only can be used for fulfilling the obligation under contract. So if you again look back at this, if the contract is for moving of material, but the contract is effectively becoming a lease contract, and in case if the subsequent steps are followed, maybe this belt conveyor will actually come on the balance sheet of the customer which is entering into this particular contract. Okay. Now let's take another example where the asset is explicitly specified. Flipzone is an online retailer, enters into an arrangement with a warehouse facility in Pune with Z-Card Logistics for the right to store the ready garments in a specified storage warehouse. The warehouse has 20 racks serially numbered, and the rack 1 to 11 are contractually allocated to Flipzone with exclusive right to use. Z-Card Logistics does not have right to substitute, does not have substitution rights. The storage space which is allocated to Flipzone represents 55% of the total storage capacity of the Z-Card Logistics. Whether the storage space, the capacity portion of the warehouse used by Flipzone meets the criterion for the identified asset. Now, while only 55% capacity is used, but the warehouse is explicitly specified in the contract and is physically distinct. There is no substitution right. You cannot replace one warehouse with another. The area within that warehouse also is specified, and therefore this becomes an identified asset. In case if the 20 racks which are there, if it was not specified, it may not have met the definition of an identified asset. Clear? Now let's look at an example for a substitution right. A customer enters into a contract with a supplier for a period of 10 years for the right to use a vehicle. The vehicle is explicitly specified in the contract whether the supplier has a substitution right. Okay, let's look at two scenarios within this example. Scenario 1, supplier has no substitution right for first 4 years from the commencement of a contract. However, after 4 years, the supplier can substitute the vehicle at any point in time. Scenario 2, supplier can provide substitute vehicle in case of unavailability. Now in scenario 1, the lease contract, it can be considered as a identified asset because there is no practical ability to substitute the asset throughout the period of use of at least 4 years. So the lease term can be 4 years, but at least at the inception, there is a single asset you cannot substitute. In the second scenario, where if the asset is not available, so that scenario may not be controlled by the supplier, but since there is an asset substitution right available, therefore it is substitution right is substantive, and therefore it may not meet the definition of lease, or may not meet the definition of identified asset in this case. Okay, so far clear? Identified asset, first criteria we covered, right? Now let's look at the second criteria, which is right to control the asset. It's not just the identified asset, but at the inception of the contract, whether you have the right to control the use of that particular asset. So what the standard goes on defining in detail what exactly is meant by right to direct the use of the asset. So if, again, common sense, if I am the occupier of the asset, if I have taken a particular asset either on lease, I should be able to control or direct the use of that specific asset. A right to direct the use of the identified asset will differentiate the lessee from a customer in a typical supply or a service contract. So if I am directing the use, then I am controlling the asset. If I am obtaining only the benefit from that asset, then it becomes either a pure play service contract in that case. The standard goes on specifying who basically takes the how and for what purposes decisions related to that specific asset. If the criterias are that if customer is able to make all those decisions, then the contract typically will become a lease contract. If supplier is able to make those decisions, then the contract does not contain a lease. If there is a predetermined arrangement that who makes those decisions, so it's already decided saying that there is a plant which has been given on an arrangement to operate, and all decisions related to plant are pre-agreed upon. You would actually need to evaluate the contract further to understand in which case it will become in which case it will become lease or which it will not. Further factors will need to be explained. Now, operating decisions, which are very procedural in nature, very operating in decisions, those are not taken into considerations unless the purpose of the use of the asset itself is. So for example, if you have rented a property, the upkeep maintenance related decisions, or to make sure that this property is properly cleaned, maintained, lit up, etc., those are very operating decisions. Those may not decide the purpose for which this asset is getting used. Those decisions are ignored, are not taken into consideration for determining the right to direct the use of the asset. There could be scenarios where let's again go back to that example of a car, that say for example, if you have specified there is a dedicated car that has been made available, Mercedes in the previous example, and the contract says that you cannot take this particular car to, let's say, high temperatures, low temperatures, etc. So those decisions also are not taken into consideration because those could be protective rights. Those rights are essentially for defining the safety, security of the underlying asset. Those could be considered as protective rights. Those may not be taken into consideration for defining whether there are right to direct the use of the asset. Let's again take an example to understand this further. A customer enters into a contract for 6 years with a supplier to install an air conditioning plant in its office premises. Air conditioning plant is designed as per the specifications provided by the customer. To optimize the efficiency of the air conditioning plant, the supplier provides an operations and maintenance services on a regular basis and as and when required throughout the contract period. However, the customer decides and directs the hours of operations and the floors of building on which and at what time cooling is required and the temperature is required to be maintained by the air conditioning plant. Now, who actually is able to control this asset? Is it customer or is it supplier? Now, in this case, customer is actually directing the use of the asset. They will decide on which floor, at what time, how much temperature can be decided. Although the operator is operating the plant, physically operating the plant, all key decisions relating to asset are taken by the customer. Supplier's right to operate and maintain the plant are not considered as a right to direct the use and for what purpose the plant is operated, right? So in this case, it still could be considered as a leasing arrangement. Let's take another example for a predetermined decisions. A customer enters into a 20-year contract with an energy supplier to install, operate and maintain a solar plant. Customer designed the solar plant before it was constructed. Customer hired experts in solar energy to assist in determining the location of the plant and the engineering of the equipment to be used. Customer has the exclusive right to receive and the obligation to take the entire energy produced. Now in this case, all decisions are done. This is an independent power plant dedicated to a specific customer. Everything is done based on their specifications, everything. So the nature of the plant is such that all decisions about how and for what purpose assets are used is predetermined. And therefore, it actually may meet the definition. Customer is deciding, and therefore it may again contain a lease. Okay. Let's move on to another example of protective rights. Customer L enters into a 2 years contract with a supplier M, an aircraft owner, for the use of identified aircraft. The contract details the interior and exterior specifications of the aircraft. It also contains contractual and legal restrictions on where the aircraft can fly. Subject to these restrictions, L can determine where and when the aircraft will fly and for which passengers and cargo can be transported in that particular aircraft. M is responsible for operating the aircraft and using its own crew. Restrictions on where aircraft can fly define the scope of right to use the aircraft. L determines how and for what purpose aircraft is used throughout the period of use. L also has the right to change these decisions throughout the period. So L is customer, supplier is M. Here the restrictions on what aircraft can fly are taken by the customer. All other decisions are taken by the customer itself. The contractual and legal restrictions on where the aircraft can fly are more in the nature of protective flight. So for example, if this flight is to go to, let's say, a Lebanon, Iraq, Israel today, and they are put in a condition saying that it can't go in that particular zone, that still can be considered more as a protective condition, and all other decisions being taken by customer, then it still can contain a lease arrangement, right? Okay, am I going too fast, too slow? I can change the pace. Okay. Any questions so far? All right. Okay, so the two components that we have covered so far is what exactly is an arrangement, whether it has an identified asset, and who's actually able to direct the use of that specific asset. Now let's move to the third bucket, which is basically talking about the lease term. And there are a few nuances, complexities associated with this as well. For the purpose of contract, now why lease term is important? Because once you've identified that a particular arrangement contains a lease, and what I mentioned in the beginning, based on the lease term, the amount that you're going to pay over that particular lease term will effectively be recognized on the balance sheet accordingly. Balance sheet as in both on the asset side as well as liability side. So therefore the term becomes important. The lease term is the non-cancellable period of lease, together with if there are any optional renewable period, if the lessee is reasonably certain to extend them, period after optional termination date, if the lessee is reasonably certain not to terminate early. So there could be, you're familiar with the word lock-in period, right? So it's not necessary only. So let's look at three separate concepts. Okay, there could be a lease term. So there is a contract period. There could be an option to renew, and there could be a lock-in period. Now we'll probably take further examples, and this is explained in greater detail on subsequent slides. But each of them will need to be taken into consideration for identifying what exactly will constitute a lease term. So first of all, what you need to identify within the contract is what period is considered as a non-cancellable. Whether it could be only a contractual period, it could be a notice period, and there are provisions which are actually allowing the termination based on occurrence or a non-occurrence of a particular contingency. So you would actually take into consideration all these factors to determine. So let us say that I have a lease term of 5 years, but at any point of time you can give a 3 months notice and cancel the contract. Then the lease term could be only 3 months. Okay, you can cancel the contract any time after a lock-in period of 3 years by giving a 3 months notice. Then the lease term could be 3 years, 3 months accordingly, right? You can cancel the contract on occurrence or a non-occurrence of a particular provision, except, like for example, if there are safety hazard related provisions, those will be excluded. But if, for example, if these are dependent on achievement of a particular target, retail industry will see in certain cases that a particular revenue being achieved, particular volume being achieved, etc. Now on occurrence of that transaction, then the period when this particular event, if you can identify when this period can, when the event can be met, then that particular period. You'll also take into consideration the enforceable period. So one which is a non-cancellable period. Within that non-cancellable period, there could be a period which is considered an enforceable period. So you would typically go through the contractual arrangement to identify which all terms and conditions that exist as part of that contract. You would also apply relevant laws and regulations. So for example, your contract may say that you cannot terminate the contract at any point of time. But for example, in respect of a property, if the stamp duty is not paid, the contract becomes void ab initio. So let's say in the earlier days, you typically would have that live and license arrangement and lease contract as two distinct positions from Bombay Stamp Act, right? Now, if you entered into a 11-month contract, or you've done a registration as a live and license agreement and paid stamp duty for 11 months, but the actual contract is for a period of 5 years, then the Stamp Act may make that contract void at inception itself, and therefore the lease term for that particular contract can maximum by law could be only 11 months. So you would actually take into consideration laws and regulations, if any, that are having impact on determination of lease terms. You have a contract, and the contract actually says that you can terminate the contract at any point in time, but it has significant amount of penalties or termination rights. If you terminate the contract, you still will need to pay the amount for the entire period. Then in substance, you cannot cancel the contract. So therefore, you will take into consideration the penal consequences also. If there are conditions that are specified in the contract, which probably are changing over a period of time. So therefore, at inception, you've determined that the lease term is identified as, let's say, 3 years, 5 years, as the case may be. But as you move along, there are underlying changes that are happening either in the regulations, circumstances, other contractual terms, etc. So therefore, if there are any significant events or changes in circumstances, at that point in time, you would actually reassess the lease term. There could be scenarios where there is a change in the non-cancellable period. Now, all those things are also taken into consideration to identify what exactly is the lease term. Now let's probably delve a little bit more detail on what could constitute a lease term in a contract, right? So what exactly is the lease term? From the lease commencement date, so if you look at the chart on the left hand side, lessee has that's the lease commencement date. From that lease commencement date, where the lessee does not have any option to terminate, that is actually considered as the minimum lease term. You can actually enforce the lessee to continue the contract up to a particular date, which is the maximum term. Okay. Now, out of which a part which is considered as enforceable under law, that is contractual, that is considered as a minimum lease period, that is considered as a non-cancellable period. And there could be a period which you know that while legally or contractually is not enforceable, you have a practical ability to extend. And we'll probably understand this by means of some examples in the following slides. So that entire enforceable period will actually be considered as a lease term. Let's take this example. Okay, let's say that you've entered into a contract to rent, let's say, a shop in on Bandra, on Linking Road, Bandra. Okay, the shop rental is, let's say, 150 rupees a square feet, and the lease term for the contract is period of 3 years, and there is a renewal option available, which is not defined, saying that parties will mutually renew the contract for another period of 3 years at a later point in time. You ended up spending, let's say, 5 crore on that particular shop. Okay, now you know that the benefit of 5 crore is actually available to you, but you will be able to recoup that particular benefit only if you use that shop for a period of 6 years, which is effectively renewal period. So although the contractual period is 3 years and there is an embedded renewal option for another 3 years, you could actually end up deciding that the total enforceable period in the contract is actually 6 years. Okay, so you would actually, so there is the institute's guidance note on implementation of the standard actually has given very detailed examples to say that which facts and circumstances you can actually consider for determining the enforceable period. Let's look at whether the renewal option, maybe similar to the example which I used, whether the renewal option is actually substantive or not. A lessee enters into a contract with lessor to lease a machinery for a non-cancellable period of 3 years, which includes 3-year fixed price renewal option. Lease payments on renewal are expected to approximate the market rate at the time of renewal, and if not renewed, there are no termination penalties. Additionally, that machinery will be used in manufacturing of components for mobile handset that is expected to remain popular until the improved model is completed in approximately 3 years. Cost to install the machinery is not significant. Machinery is not expected to be used in manufacturing of any other type of handset. Remaining economic life of the machine is 12 years. Now here the contract is for a non-cancellable period of 3 years, includes a 3 years fixed renewal option. The estimated useful life of that machine is 12 years. Now there are, given the type of asset for which this machinery is used, which is mobiles in this case, there is no economic incentive for the lessee to actually exercise the renewal option. So therefore, you would consider the lease term as only the original lease term of 3 years. You may ignore the other lease term. While the contract has a renewal option, but given the rapid technological changes that are likely to happen in using of this particular machinery, therefore the lease term could be considered as only 3 years and not 6 years. So you would actually look at the facts and circumstances. Now in this particular case, or the two examples which I said, you said there is no cancellation clause. But if there is no cancellation clause, then the contractual term itself is for, in my example, 6 years. So therefore, then the lease term will be considered as 6 years. What we are talking about here is, in this example, the minimum period is 3 years. There is a renewal option, and that renewal option, whether you will actually exercise that renewal option or not, is determined based on facts and circumstances surrounding the arrangement if the contract is not clear. If the contract is very clear saying that the lock-in period itself is 6 years, then you would actually consider 6 years because that's the defined lease term. The example that we are talking about is where the original contract period is for a period of 3 years, there is a 3-year renewal option, and in which scenario you would actually consider that additional renewal option and then define the lease term being 6 years or not. Clear? So that clause should be there either explicitly or implicitly. So let's say in a contract, and probably these things will become a little bit more complicated in India, especially because of the taxation. It could be stamp duty, could be registration, could be GST, etc. And therefore, from a other laws regulations perspective, there could be an enforceable amount to be mentioned. Assuming none of that is applicable, the contract simply says that you're entering into a contract for, let's say, a period of 3 years, and it can be additionally renewed for another period of 3 years. Effectively, say for example, let's look at two scenarios. Stamp duty is applicable, but you paid stamp duty only for a period of 3 years. So unless until you pay stamp duty, the contract does not become applicable for the next 3 years. So therefore, you will consider that term to be 3 years. Now let us assume that the stamp duty is not at all in picture. You are not considering stamp duty at all. Okay. Then you may think about other alternatives, terms, conditions, saying that, say for example, are there any other factors that influence the decision or that will force the decision to consider to extend that contract up to 6 years. Now in the two examples that I gave, in the first example, you've done expenditure, and which probably will be recouped. You may not be, and that expenditure is, let's say, specific to your showroom itself, and therefore it cannot be utilized by any other party, and therefore your economic incentive to continue or renew is very, very high. If that renovation that you have done, which can be used by any other shop as well, any other occupant as well, you may still consider the renewal option not been substantive. And in the second example, where the asset is dependent on use of technology, in that case they are saying that considering the rapid changes in technology, the renewal option is not considered as substantive, and therefore the lease term could be only period of 3 years. Clear? Again, similar example which I have already covered, reasonably certain criteria. Entity X, lessee enters into a lease contract for a retail shop for initial non-cancellable period of 4 years, which includes a renewal option for further period of 3 years at the same rental. Entity X pays for leasehold improvements carried at its behest by the lessor. Further, at inception, the rentals are at market rate, but market rentals are expected to increase by 12% per annum over the lease period. Entity X expects to run the shop for at least 8 to 10 years period. Location is advantageous for profitable business. Leasehold improvements are expected to have significant value at the end of 4 years, and the value can only be realized through continued occupancy. So I probably covered that as part of my example as well. And therefore at inception, that lease term that would be considered would be not 4 years, but 4 years plus 3 years, which is 7 years. So therefore I will actually consider the lease term being 7 years. Clear? Now we've actually covered the first 3 aspects. Let's move on to the fourth one, which is in exchange for the consideration. So the way in which the lease contract will or the leasing standard will work is, once you have an identified asset, once you've identified the term for which the contract is there, then what all amounts that should be considered as part of a lease rental, using which you are going to recognize a right of use asset on the balance sheet. It's not very simple. There are judgments that are involved in identifying which all items could constitute a lease consideration. So what the standard actually goes on to say, these 4 buckets. So fixed payments, less any lease incentives. So for example, if the contract says that my rental would be let's say 1 lakh rupees per month, but there are certain lease concessions, incentives, discounts, etc. been offered. So those amount less discount, so fixed amount which are easy to identify. The second criteria, a little bit more complicated, is variable payments, but variable payments are included only and only if they are actually depend on an index or a rate. So for example, again in a retail shop or a retail industry, you may end up doing an arrangement saying that rental is, let's say, 1 lakh rupees a month, a fixed amount, and 10% of the sales volume that you do. Now that 10% of the sales volume, since the sales volume cannot be predicted, therefore it is not considered based on a rate. If it is based on a rate, let's say it's based on an escalation percentage, it's based on an index, let's say it's something which is based on inflation index, etc., then you would actually take that into consideration. If there are any options embedded within the contract, then you would also take into consideration the probability of exercise of that option. We'll talk about put and call options towards the end when we talk about sale lease back. But if there are any options that are existing in the contract, you will actually take into consideration those options along with reasonably high certainty only. And payments of penalties for terminating lease if the lease term reflects lessee exercising that option. So you have a lease contract over a period of 5 years, lock-in period is 3 years, but if you terminate at the end of 3 years, you need to pay the additional rental for the remaining 2 years, then you will actually take into consideration the entire amount payable over a period of 5 years. Okay, let's take into consideration another example. Entity X lessee enters into a 20-year contract with a power company, entity Y lessor, to purchase electricity produced by a new solar plant set up by entity Y. The contract is assessed as it contains a lease. There are no minimum payments requirements, no fixed payment required. However, entity X is required to purchase all of the electricity produced by the solar plant at a price of INR 10 per unit. It is highly probable that the solar plant will generate at least some electricity each year. Now, while the solar plant will generate some electricity, all payments vary based on the actual output that is produced from solar plant, which is actually not dependent on any index or rate. So while 10 rupees per unit rate is fixed, but how many units of electricity generated is not fixed. Okay, and therefore this is not considered for calculating the lease rent amount or lease payments, and therefore calculating my ROU asset or a liability. Now, in the same contract, let's say that if there is a clause saying that it is assumed that per month 200 units will be minimum guaranteed irrespective of the actual electricity. If that is the case, then that 200 into 10 that actually will be considered as part of a lease rental in that case. Okay, otherwise it's a variable rental. Variable rental again will be covered as part of leasing contract, but you don't create an ROU asset. You would actually recognize that as an expense in P&L, and there are certain disclosures required as well. Okay, variable and fixed payments. Another example, entity X leases, enters into a 20-year contract with a power company. I think the same example with the variation which I already explained, a minimum payments of 10,000, and if there is a minimum amount which is specified, that minimum amount will classify as lease payments for the purpose of this standard. Let's look at the evaluation of a purchase option as well. Yes, please. So basically, two things. One, if there is a fixed amount or whatever is the lease payment that is considered, the way in which the standard requires you to recognize is the minimum lease payment over lease term are accumulated. You would discount it at effective interest rate, and I'll cover that in a little bit more detail when we come to accounting. That net amount is identified as your lease liability. There are certain additions to that lease liability as per the standard, and you recognize that as a right of use asset. So you would actually present a right of use asset, corresponding amount as financial liabilities. Now, there are disclosures in the standard which basically say that what all things that you will disclose for ROU assets and financial liability. Now, to the extent under the standard, the payments made under a leasing contract do not meet the definition of a ROU asset. It is like traditional accounting standard. It is recognized as a lease expense in P&L. And the only thing which is then required to be disclosed, there is in the notes to account, is on cancelable lease or the standards which are or the assets which are not meeting the definition of ROU, what is the expense recognized during the period is disclosed as a charge to P&L and by means of a note. So there are certain additional disclosures in the notes as well. Okay, you actually need to disclose small value leases, short-term leases, and other lease payments collectively by means of a note additionally. Okay, evaluation of a purchase option. Lessee X enters into a non-cancelable 5 years lease term with a lessor Y to use piece of equipment in an evolving area of technology sector. There is no renewal option, but X has the option to purchase the equipment at the end of the lease term for 50,000 rupees. Because this piece of equipment is used in evolving area of technology sector, which is subject to rapid change, the fair value of the equipment at the end of the lease term is subject to significant volatility. The estimates range from 40,000 rupees to 90,000 rupees. The duration of the non-cancellable period of 5 years is significant in this context. This reflects, for example, the newer and or better alternative assets may be introduced during the 5 years lease term. Now, if the amount itself at which you are likely to purchase the asset is dependent on an event which is not within your control, in that case, X will make the assessment of the economic incentive to exercise the option. So you have a rare asset, price is not within your control, but it's more likely than not you are likely to exercise that option, then you would actually take that purchase option into consideration. So for example, if the market value is going to go down from 40,000 or going to go up to 90,000, and because of that you are more likely than not to exercise that particular purchase option, in that case this purchase option will also be taken into consideration as the cumulative lease payments to calculate your right of use asset. Another example of payments linked with index or rate. Entity A enters into a 10-year lease of property. The lease payment for the first year is 1,000 rupees. The lease payments are linked to the consumer price index and not a floating interest rate. The CPI at the beginning of the year 1 is 100. Lease payments are updated at the end of every second year. At the end of year 1, the CPI is 105. At the end of year 2, the CPI is 108. At the inception, the potential changes that are likely to happen, because you are forecasting the consumer price index, and consumer price index is not identified at inception. It is not certain what will be the amount of consumer price index, and therefore the future changes that are dependent in the are linked with the consumer price index that are not considered at the inception. At the end of year 1, payments have not changed, so the liability is not updated. At the end of the year 2, when payment change, so because at the end of year 2, when the payment is actually updated to 108, at that point of time your lease rental amount is changing, and therefore your remaining liability amount is also likely to undergo a change. So if your forecasted payment are changing, you will continue to update the assessment at a point in time when you are able to reliably measure that, and this is possible only if the payment is linked with index or rate. Okay. Let's touch upon some of the other requirements. So the basic fundamental accounting, how exactly is different as compared to the erstwhile accounting is, you've identified the asset, you've identified what is the lease term, identified which all payments that will be considered as part of lease payment arrangement. Those are plotted over the tenure of the lease term, and then they are discounted at a discount rate. Now, what this discount rate would be to calculate financial liability is also specified in the standard. The standard actually says that the rate at which you will discount will be either a rate implicit in the lease, so effectively the IRR for that specific lease, or it could be an incremental borrowing rate. Now, this particular aspect has definitely created a lot of challenges for a lot of companies, because identifying rate implicit in the lease is very, very difficult. If I'm going to compute an IRR in an arrangement, let's take two examples. If say Infosys is buying 1 lakh laptops for their employees versus a small IT company buying 10 laptops, the implicit rate of return for that same set of asset could be significantly different, and therefore in most scenarios the minimum return expected on the specific asset could be more challenging than not, and it could become very subjective. And therefore, when the transition to IND AS 116 happened, in most scenarios the companies have actually used incremental borrowing rate as the discount rate. Yes. So there is no difference as far as technical literature is concerned. The literature allows both the implicit rate of specific to the asset and incremental borrowing rate. At least I don't recall. I'll probably reconfirm, but I don't think that there is any. I'll reconfirm. I'll check and probably tell you immediately after this session. Just go to the bank, ask them what is the incremental borrowing rate easiest. The way in which you will compute IRR, for you basically will use a guess rate, discount that estimated cash flows, and whatever gives you an precisely. So that's the practical challenge, saying that a guess rate is not difficult. You can do that, but what is the benefit? So for example, for you to arrive at a discount as an IRR for, let's say, this laptop, what is the available use, what is the estimated use, is specific to you, not necessarily only to you, but specific to an employee, specific to a department's function, and therefore the IRR may keep varying, and the computation may become a bit more complex. Very subjective. So the standard does not give you any guidance on this at all. It just simply says that use an IRR effectively, which discounts. If I distinguish this between established industries, so let's say a leasing industry will probably be able to compute this very regularly. You have very defined use, established financial model, established price points, benefits are available from the use of that assets, then IRR is computed relatively easily. But I agree completely that it actually becomes very subjective, and therefore most companies have used, practically if you open any balance sheet and actually see there are disclosures required, if you see, they would actually say that the companies use incremental borrowing rate. Much simpler. Yes, please.
So in Indians, we always say that we are fair valuing our balance sheet. Okay, in the current scenario, if we'll see, the interest rates are very high. Okay, and we do expect, considering the Fed meetings, that interest rate are to be reduced in the nearer future. Now suppose if I'm taking an asset now, okay, and the MCLR which I'm getting in from the bank is at 8 to 9%, in which I will add some premium of say 100 bips or 200 bips based upon the company. Okay, so, and over the period of time, the interest rate definitely will be reduced. So don't you think at given point of time, though I'm giving the fair valuation, but in the nearer future, when the interest rate will be low, but still I will be charging to my PNL from the higher interest rate.
So maybe I'll answer your question in a slightly sarcastic, hilarious manner. The most unfair thing under IND AS is fair value. So therefore, what is a fair value is a matter of guesswork. So while there are adequate disclosures, guidances, etc., that have been given, so therefore a fair value can be completely different. Although it says that between knowledgeable, willing buyer, seller, arm's length transaction, etc. Can that be same? It cannot be same. It all will depend on the credit rating that you have. It all depends on tenor, etc., etc. Now, the only difference or to the specific question that you've raised is, what you need to do is you need to identify the rate at the inception of the lease. Okay, so if the interest rate is likely to change, you're not considering that. You are only identifying the rate at the inception. So let's take an example. You've taken, let's say, an office building on lease. 1 lakh rupees per month is the rental, and the discount rate that you've taken today is 10%. Let's take scenarios. Your contract is for a period of 5 years or for a period of 10 years. 3 years down the line, the interest rate become 8% or interest rate become 10%. The standard does not require you to remeasure the lease liability at that point in time. you've measured the lease liability at the inception. So irrespective of whether your actual interest rates are undergoing change, increasing or decreasing, the ROU computation and lease liability is not undergoing a change. Yes, that will ROU or lease liability is changed only and only when there is a modification in the lease, and we'll talk about modification in the subsequent slides. So to that extent, there is no impact as such of this interest rate changes in the subsequent period.
So from the balance sheet point of view or the P&L point of view, if I see, so at a given point of time, I might be having a new loan which is charged at the lower rate, and the interest liability which I'm charging at the higher rate in the P&L.
But that's the way business works, right? So if you've taken a borrowing 20 years back at say 7%, and that borrowing is continuing, and you take a borrowing today which could be at 14%, yeah, both those loans still prevail. So how is it different? So the measurement under the standard is not undergoing a change. The at a subsequent measurement, the liability is getting measured at amortized cost, and typically the amortized cost in that case will continue to be the effective interest rate applicable to that particular liability. So it's not going to undergo a change, because the way in which, and we'll probably talk about that computation also a little bit. So take a very simplified example. Let's say you have 1 lakh rupees over a period of 10 years. So 10 lakh rupees you paid, you discounted them at an interest rate of 10%. Okay, and you're actually going to, the way in which your fair value accounting is going to happen is, you're going to impute interest at 10%, discount them at 10%. So therefore the liability, to the extent of cash flow, your liability will remain predictable. Unless my imputation rate is going up or discount rate is undergoing a change, there is no impact of that on the valuation of that liability or recognition in P&L of the changes in that liability. And therefore this, to that extent, subsequent interest rate changes may not have significant impact on the financial liability under IND AS 116. Clear? Yes, please.
Sir, as on 31st March 2024, it is in first year of IND AS. So companies having a lease agreement which is valid for 20 years. So 31st March 24, 23 and 22, 3 years balance sheet company will have to prepare because it is first year. So while calculating this 116 adjustment, which year as on 31st March 24 we have to take the rate, or as on 31st March 23 or 22?
So one aspect which I have not covered as part of this presentation is the first time adoption. So under first time adoption, there are basically 3 options. Okay, it is option 1, 2A, 2B, and depending on which option you take, the discount rate will be. So in instead of getting into complicated explanations, broadly there are 2 options. You either do a retrospective restatement or you do a prospective restatement. If you're doing a prospective restatement, the standard actually allows you an option where your asset is equal to liability, and that is discounted. And there, if you're taking a 2B as an option, which is prospective asset equal to liability, you would typically take into consideration the discount rate on the date of adoption and will not go back in history to change that. Therefore, on the first time adoption, when the standard became applicable, I think 2018 for the first time, most companies have used prospective application unless until you had some specific reasons to going back and restating the past liabilities. So typically, and this guidance is there in the standard itself in the first time adoption in detail. Okay, any other questions? Should I move on? How are we doing on time? 3:15. We have time? Okay. So there could be arrangements where you're actually entering into a contract which has both lease as well as non-lease components. So a typical example, and I've actually covered that as part of this, is let's say you've rented an office premises, you pay both CAM charges, so common area maintenance charges, as well as rental. Okay, so common area maintenance is a non-lease component. That is not my rental. My rent only is considered as a common area maintenance. So in scenario where it actually there are both lease and non-lease components, the standard actually requires you to follow a 2-step approach. Okay, first of all, the non-lease components are identified separately, and you actually have a policy choice, and that is lease by lease policy choice. If it is too cumbersome for you to identify the non-lease component separately, otherwise you can actually combine the lease component and non-lease component for the purpose of computing the right of use asset. So let's again, in a same example, I was paying 1 lakh rupees a month as a rental, and I paid 20,000 rupees as a common area maintenance charges. I can actually take 1,20,000 as a combined and obviously make a disclosure so that it becomes easier. What have companies done? They have obviously used different scenarios depending on 1,20,000 will obviously mean that you are inflating your balance sheet. By using 1 lakh, you mean that 20,000 will get charged off in P&L on a regular basis. So, and I'll explain the implications on P&L when I talk about the last price. Now, what the standard also requires you to do is, in the same example, if 1,20,000 are the lease and non-lease component, if you decide to separate the non-lease component, it should not be the contractual amount. You will actually need to do a fair value allocation. So for example, out of these lease rental, if my market value of lease rental is, let's say, 1,10,000 and only 10,000 is maintenance, and because of whatever taxation or other reasons they've actually charged, you would still consider 1,10,000 as lease rental if you choose to separate the lease and non-lease components under the standard. Just quickly touch upon an example how non-lease components are excluded from lease liability. Lessee B enters into a 5-year lease of photocopier. The lease payments are 10,000 rupees per annum. The contract includes additional maintenance cost of 500 per annum. B considered the contracted payments and separates the service component of the lease, that is maintenance cost, as a non-lease component. B notes that based on the observable price, the lease and non-lease components are priced at their standalone prices. So if I were to buy maintenance separately, I would have paid 500, and if I were to buy only lease, I would have paid 10,000, and therefore the standalone selling price being fair value, you would actually separate and record. If the standalone fair value was not same, then you would obviously do a relative fair value approach. So you would add them and distribute this particular amount in the ratio of whatever is the standalone fair value. And therefore maintenance cost is excluded from the lease liability and recognized as an expense as and when incurred. I mentioned about the practical expedient. As a practical expedient, a lessee is permitted to contain lease and non-lease components and account for them as a single component. Okay, so moving on, so it may so happen that a lease contract that is entered at the inception undergoes changes, okay, and there could be different types of changes. There could be changes relating to increase or decrease of duration, amount, basis, etc. So what happens when there are modifications in the contract? The typical common examples which have been given in the standard for modification include increasing the scope of lease, which end up increasing the ROU asset, decreasing the scope of lease term is changing, amounts are undergoing a change, etc. So all 4 components that we have seen can undergo a change. The changes that result from negotiation of the original contract are considered as a modification to the leases. There could be 2 alternative approaches, and we'll probably understand that in a greater detail. So when a change in the lease contract happens, the first is if there are changes in the carrying amount of lease liability. If the change is relating to any monetary consideration, you would actually reassess the lease term, purchase option, residual value guarantee, and accordingly adjust that to right of use asset. So in the example that I used, 1 lakh rupees, 10 over 10 years period, at the end of the 5th year, the lease contract is undergoing a change. The rental is either increased or decreased and becomes 1,20,000. Then that ROU asset is increased or decreased. Accordingly, the amount is adjusted to the ROU asset itself. The reassessment of variable lease payment based on, so we saw that example where it was linked with consumer price index, and when the consumer price index is actually realized, the rental amount is undergoing a change. If those are actually changing, you would actually make the changes with prospective effect. So, okay, and accordingly, if it is related to future period, you would make that change on a prospective basis. If it is related to only current period, you would recognize that in the current period. If there are any other changes which are variable lease payment, which are not dependent on index or rate, any changes to the lease agreements, lease considerations would be recognized as an expense in P&L. Now there is also guidance given in terms of whether the modification in the leases increases or decreases the ROU asset, in whether those changes are in line with standalone selling prices prevailing at that point in time, whether it would be considered as a separate lease or whether it's a modification. We'll cover one example and then come back to the slide once again. Lease modification. Lessee Z enters into a lease contract with a lessor to lease a floor in building for a period of 10 years. Z's business has expanded, requiring additional office space. At the beginning of year 7, Z and L amend the contract to grant Z right to use additional floor of office space in the same building for a period of 4 years. The new office is expected. The new office space is the same size as the original office space and similar in all significant aspects. Lease payments for the new office space are commensurate with the market rate for office space of that size and characteristics. However, Z receives a 5% discount for the new office rental because the existing relationship with L enabled to forego the cost that would have been incurred if additional floor had been leased to a new tenant. Example, marketing costs, rental agents commission, cost for undertaking credit checks, etc. Now, while there is a 5% discount, since the new lease is at a market rate, this lease is considered as a separate lease. So if I come back to this example, if there is an increase or a decrease in the lease contract by increase or decrease of the right of use asset, what you need to determine is it at a standalone price at market value or not. Now in this example, this is let's say the rental payable is for a period which is at market price, so therefore it is considered as a separate lease. If that is not at a market price, if 1 lakh rupees was the prevailing market rental, and because I'm an existing occupant, I'm getting, let's say, a 40% discount. In this case, 5% discount has been given, but if I'm getting a 40% discount, then it is considered as a modification of an existing lease. So what will happen is you will measure the existing ROU asset and a financial liability, remeasure that with the new amount, and any modification gain loss, because you are measuring both the ROU asset and ROU and the financial liability, any resultant gain loss will actually be recognized in P&L accordingly. If there are any modifications which are not at standalone selling prices, or if they relate to current period, those actually are remeasured as lease liability and adjusted ROU assets, and that is not considered as a separate lease. It is actually modification of existing lease. Any changes to existing lease, the net impact is recognized in P&L. Typically, any decrease in scope of a lease contract will always result into remeasuring of lease liability, and resultant gain or loss is recognized in P&L accordingly. Okay, probably last concept, sale and lease back. Fairly complicated from an arrangement perspective, but fairly common as well. So let's say that I have an asset sitting on my balance sheet. I have a building in BKC. It's let's say a 10-year-old building. It probably requires a bit of repairs, maintenance. I don't have a cash flow to maintain that. If I continue to occupy the building, I'll obviously need to incur certain expenditure. So what I do is I walk across to all these financial institutions which are sitting in BKC. I actually tell them that I want to do a sale and lease back arrangement. So what I can do is, let's say the property value, let's say a building in BKC would cost, let's say 500 crore. You are actually selling that building to a financer. The financer is then giving you the lease back. Okay, so he's again giving you the property back on an operating lease. What exactly will be the accounting treatment of that? So first and foremost is the standard requires you to assess whether the sale itself is concluded or not. Okay, and for that the standard refers back to IND AS 115. So under IND AS 115, what all conditions, the 5-step model, if the sale is concluded or not. One of the key aspect that is considered first, whether if there is a performance obligation, that performance obligation. So in case of property, maybe have you transferred the ownership, have you paid stamp duty, registration, all risk rewards related to that property have been transferred to the seller or not. Those conditions will be assessed and evaluated. If the sale is concluded as complete sale under IND AS 115, then it is considered as a sale and leaseback transaction. If under IND AS 115 the sale is considered as a failed sale, then the asset will not be derecognized. It will be considered or classified as a failed sale transaction, and it will be treated as a financing transaction. You effectively will continue to recognize the asset on balance sheet. You will not recognize the gain or loss, and you would recognize the corresponding amount received from the sale of property as a loan, as a financial liability. Okay. Now, which are those conditions? I'll probably cover only one example from all those examples that are there under IND AS 115. You've covered probably separately revenue recognition standards, so you understand all those options better. I'll touch upon only two aspects for the purpose of this evaluation. Let's say in the property, if there is a forward call or a put option, forward or a call option or a put option. So what is a forward option? In a scenario where the seller of the property is certain to buy back the property at a future price. That is a forward option. There is no, that is a forward contract, that there is no option in forward. The call option is where the seller has certain conditions to be made, or if there is a call option to buy this, seller's right to repurchase the property at a future date. If these two scenarios exist, the standard, what it requires you is to assess whether the asset is purchased at less than original price. If it is purchased at less than original price, then it is considered as a lease arrangement. If it is purchased at higher than original price. So just again explain that with an example. I have a property building in BKC. The carrying value of that building is say 300 crore. I am selling that building at 500 crore to, let's say, ICICI Bank, and ICICI Bank is agreed to sell that property back to me. Two scenarios, at 400 crore and at 600 crore. 400 crore less than the original purchase price, then it is still considered as a leasing arrangement, because effectively I am compensating the difference between of 100 crore back by means of lease rentals, and therefore it is still considered as a lease agreement. If it is 600 higher than, then it is considered only as a financing arrangement, and therefore that amount will be recognized as a liability on the books. The second part, this is regarding the option which the seller has. Similarly, the buyer may have that option of putting back the property back to the owner itself, which is a put option. Again, here also you would take into consideration whether the repurchase is greater than the original selling price or not. If it is greater than the original selling price, then is it at market value? If it is not at market value, then is the customer having any incentive of selling that property? So say for example, I had done a sale and leaseback transaction and the property market has crashed, and therefore he is forced to sell that property back to me because there won't be any other tenant available to him with that prevailing price, and therefore there is an economic incentive for the buyer to sell the property back to me at a lesser value than what he purchased originally. If there is an economic incentive available to that, it continues to be a lease. If there is no economic incentive, then it is treated as a sale with right of return. And these transactions will need to be, again, the guidance at a principal level itself is complicated, but you would need to evaluate all the facts and circumstances in each case. That's all from concepts covering leases. Probably touch upon two specific aspects: the accounting flow, how that works. So what we've seen so far is we've seen what exactly is considered as a lease. For something to constitute a lease, you would need to have an identified asset. You would define what all lease payments that can be covered. You would identify what tenure for which the lease contract is. You would identify what is the discount rate that is available. Once you have these four aspects available, you would actually compute the total financial liability, discount that financial liability at the discount rate to net present value, and actually first of all compute and arrive at the financial liability, lease liability first. To that lease liability, when you make certain additions, you actually reach to the right of use asset. So which all additions? Any initial direct cost, so any commission, any brokerage, any other expenditure that is incurred specifically to lease, you would add that to arrive at the right of use asset. Estimated cost to dismantle, you've seen that as part of IND AS 116, IND AS 16, which is mandatory. Any retirement obligations relating to that asset. Any deposit, so the difference between the net present value of the deposit amounts that have been paid, any prepaid lease payments, example deposits, those will be added to the financial liability. Any lease incentives received or receivable will be reduced, and the amount that you arrive at is the right of use asset. So that's how you created all the complications from a lease expense accounting or a finance lease accounting. Now brought back those assets and liabilities on the balance sheet. They would be recognized as a right of use asset presented on the balance sheet below the property, plant and equipment as a separate line item. Financial liabilities presented on the liability side, bifurcating between current and non-current liabilities. That's how the accounting will happen. It obviously, the standard definitely had a significant impact on the financial statements. Most balance sheets were inflated because the assets and liabilities both went up. Now the trick is that this is not just a one-time impact. If you actually logically think, what is the subsequent measurement on the balance sheet side? I have an ROU asset. That ROU asset actually gets depreciated on a straight line basis, and therefore it will reduce gradually with a fixed amount going in as an amortization. Okay. Financial liability, on the other hand, will actually change based on how exactly the cash flow payments are happening, and therefore it's very likely that my asset gets depreciated faster and my liability is not depreciated or not reduced that much. So therefore there, as compared to the older standard, there is bound to be some mismatch where my liability is higher and my assets are lower to that extent. So over a period of time, so what I've done is I've just plotted from a graph perspective. On day one, if I've taken the 2B option on first time adoption, my asset is equal to liability, but my asset depreciates faster. My financial liability, assuming that mode of payment is linear, will reduce lesser. So it will definitely have impact on the way in which my balance sheet is presented. My gearing ratios will undergo a change. As compared to the old standard where the lease expense was getting recognized on a straight line basis as an expense as part of my operating expenses, now that expense is split. Part of it goes above as part of my expense, depreciation, amortization. So ROU asset is amortized, and that amount is added to my depreciation, amortization, and the interest expense, the notional interest expense on the liability gets obviously recorded along with my finance cost. So that is effectively having an impact on P&L. Typically, because the financial liability amount being higher, my interest cost in the initial period will be higher. So if you compare the straight line accounting under IND AS 17 as compared to that, the charge to P&L using the IND AS 116 model will be higher. My profits will be lower to that extent. And total lease expense will be front loaded to that extent. The overall impact from financials, analytics perspective, my net assets are going to decrease because higher liability, lower asset. My gearing ratios are bound to change. I'm recognizing higher interest costs initially, and my net assets are going, so my gearing ratios are different. Balance sheets will look differently. So if you compare probably industries which are very rental incentive, retail for example, their balance sheets, if you compare their balance sheets pre-IND AS and 116 and post-IND AS 116, they would be significantly different. You will see balance sheets being inflated and profitability being lesser to that extent. There are two exceptions to the recognition and measurement principles. One, and this is again a policy choice that you can make. Any lease, this entire exercise of recognizing value asset, financial liability, if your lease term is less than 12 months, you can actually not apply the leasing standard. The entire lease expense get recognized in P&L in the olden way. And the second one is relating to small value asset. While the standard does not define what is small value, judgments will be required. You will need to get a buy-in from your auditors as well. But companies have generally taken exceptions, probably anything between 1 to 5 lakhs worth of lease payments. Again, depends on the size of the company per month, per annum. Those also have varied very significantly. They've actually not done lease accounting. So especially computer related laptops, printers, Xerox machines, etc. A lot of companies have opted to use the small value exemptions and have recognized the expense over in the olden way. You can actually make this policy choice lease by lease for low value exception. So companies have widely used this for especially high volume, low value kind of assets. They've used that. Like in the initial period, almost every company started identifying even coffee vending machines also as part of leased assets. Hopefully that maturity curve settled very quickly, and even laptops, printers, computers, desktops, etc. are also not been included in many cases as well. That's it. Happy to take up any questions. Yes, please.
Sir, there are cases where agreements are entered into for say 11 months, and the agreement states that the parties can extend the agreement by terminating this agreement and entering into a new agreement at the end of 11 months. So in such cases, can we say though they are going to terminate the agreement, but there is right to exercise an extension? So depending on the assessment, we will determine the lease term or we will take it as 11 months.
No, so you will, so there is a very detailed guidance given in the implementation guide issued by the institute. You would actually evaluate, so two parts here. One, if the contract does not specify renewal option at all, okay, practically you will need to enter into a new contract every year. And therefore, if that be the scenario, in certain cases, the auditors would still want to evaluate why there is only a 11 months agreement or a 12 months agreement. Say for example, you entered into a, let's again use the same building example. You rented a building in BKC, have paid rental, made rent arrangements for 1 year, and you know that the amount of expenditure that you've incurred will necessitate you to stay there for a period of 10 years. Okay. Now the practically I don't know why you would do that every year you're going and doing a registration, etc. Typically, there could be two scenarios where for a small value, low value items, or items where you are not certain about renewal, you enter into similar contracts. What the standard says that you would actually evaluate the economic compulsion for you to either renew or not renew that particular contract. Now, again, using that property example, if you've done a significant amount of interior fit outs expenditure and there is no way that you will be able to recover that, it's very unlikely that you're going to give up that entire expenditure free of cost to the next incoming tenant, and therefore you would typically consider that there is no clause in the contract, but in substance there is a leasing arrangement for a longer duration. At the same time, will be very difficult if the contract does not specify renewal option at all. If a renewal option is specified but commercial terms have not been agreed upon, then it becomes easier. So you would definitely evaluate facts and circumstances and then only conclude this. Okay. Any other questions? Thank you so much.
Thank you, Shashi sir, for decoding IND AS 116. So now we will have a tea break of 10 minutes. Tea is placed outside the auditorium. Then we will start the next session. Thank you.
दो पीपीटी आपने भेजा ना, कौन सा ना?
इसमें पीडीएफ वाला मत करो, जो
ये वाला ना, ये
पीपीटी ठीक
ये ले लो ना।
हाँ कर
पीपीटी ओके। ये ना,
इधर मुझे वो दिखाई देगा, वो नहीं देखा।
बोलो। हाँ बोलो। बात आधे घंटे बाद
वो मुझे भी दिखाई देगा, वो वैसा नहीं देखा। नोट्स ये जो दिखाई देता है ना नीचे के मेरे नोट्स, कौन से फॉर्मेट में आएंगे?
Welcome back. So now we have the next presenter for the practical aspect of IND AS 115, Mr. Tejas Parikh. So presently he is partner in KKC and Associate LLP, formerly known as Khimji Kuverji and Co. Company LLP. His professional journey with over 16 years of progressive experience of leading teams and undertaking financial statement, audit of companies which include large manufacturing companies listed in stock exchange and business valuations. So academic qualifications are, he holds a strong academic foundation, being a member of the Institute of Chartered Accountants of India since 2006 and law graduate from Government Law College, Mumbai University. In addition to this, he is a registered valuer and insolvency professional. He also holds IND AS certification and valuation course certification from ICAI. He is presently chairman of Accounting and Auditing Committee of Chamber of Tax Consultant and part of Managing Council of Chamber of Tax Consultant from last 4 years. Now I would request Nikita to present memento to Tejas. So. Now I would call upon Tejas for the seminar. Thank you.
Thank you, Amruta, for kind introduction, and thank you, WRIC, for inviting me on this topic. I think we welcome also Durgesh. Thank you for raising for today's last session. Yeah. So this was a part of last session, which was on revenue recognition for revenue with contract from customers. It is under IND AS 115, and I think the topic today which was allotted was practical challenges which people generally encounter for a manufacturing and IT companies. Of course, I have tried and covered many examples other than IT companies just to drive the concept about what is dealt with in IND AS 115. So I think if someone would have earlier experience or would have been involved in a transition, one would see that IND AS 115 is similar to AS 9 earlier, but is giving more and more guidance. Earlier there was no guidance available, but this is far more comprehensive. Of course there are some differences, but IND AS 115 has given a more comprehensive. It does not deal with the risk and reward. It gives a far better guidance, and I think it has been taken from IFRS 15, from IFRS set of standards, and I think lot of deliberations and everything has happened where especially in the companies where there were bundle type of contracts, where people were following a different revenue recognition measurement and recognition policy. With all the feedback from world over as to what can be the best, I think they have come out with the set of a standard, and I think they have defined a lot of model as to the 5-step recognition model, which in our earlier AS 9 also there was set of guidance, but it was just restricted to transferring of risk and reward. So 115 is slightly dealing with in a greater depth, explaining you. I think it is more of a guidance and explaining you some concepts in a fairly greater detail. My part of the presentation are the views of mine, and it is not necessarily of the firm in which I am working. But yes, I have taken many examples from ICI technical guide, ICI educational material, and I think that is just to drive the concept. So I think, and it has explained very well. So if someone wants to study IND AS 115 in a greater length, I think there are 4-5 materials which are available, which is educational material on IND AS 115. Even I think the new CA syllabus on a financial reporting has talked about IND AS 115 with many examples, and I think those are largely a very real life example, which some of them I have covered in my examples. And WRIC has released a publication on unique IND AS disclosure. I would request everyone to go through that, because I think everyone understand the revenue recognition, but I think in the haste of complying, we miss out on the disclosure aspects. And I think in the last recent times, I think FRRB has given lot many errors which they have found out, which also I will cover in what are the presentation and disclosure requirements under IND AS 115. With this, I would, and happy to discuss. I think if someone has experienced something, I think do share your thoughts. I think that will help in overall understanding of all the participants. So yeah, so IND AS 115, I think it's a comprehensive which I discuss. It does not cover, there is a scope out where I think lease standard, insurance contract, financial instrument, and certain non-monetary between entities in the same line of business where there are exchanges other than money are not covered under IND AS 115. So this is a scope out transaction under 115. A brief comparison, I think IND AS 115 replaces earlier IND AS 11 and 18. So this is covering even the earlier construction contracts. I think people would have earlier seen that even in AS 7 there was a standard of a construction contract. Similar to that, it was IND AS 18. So the IND AS 11 and IND AS 18 or revenue recognition. So this IND AS 115 is the combination of all the standards, and I think now IND AS 115 is the one guide which covers everything. IND AS 115 also gives a more guidance on service concession arrangements, which I have not dealt with in today's topic in a greater length, but it is largely for an infrastructure company who gets a toll BOT contracts, how one should recognize. Should we recognize as an intangible asset or should we recognize as a financial asset? That has been covered largely in IND AS 115 in the form of an appendix. So if someone is doing an audit of an infrastructure company, do refer this service concession arrangement, which is given in the form of an appendix to IND AS 115. So in IND AS 11 and 18, there was very limited guidance on multi-element arrangements, whether there are distinct goods and services. Whereas here, under IND AS 115, there is lot many examples on how the transaction price has to be determined, whether the goods and services are distinct, not distinct, whether performance obligation is satisfied over a period of time or at in point in time. This all guidance have been given fairly in a greater detail in IND AS 115, which was not there in earlier IND AS 11 and 18. Of course, there were lot many ESC opinion which institute has came out in a guidance, like for a real estate there was a guidance note which was there, which was helping the members to follow for real estate transaction. But now that guidance note also on a real estate transaction has been withdrawn by ICI, and 115 is the one guide which everyone will have to follow in total. So I think some key definitions which are covered as to what is a contract. So I think one can take from Indian Contract Act. So similar definition which is there over here, the legal binding agreement between two or more parties and enforceable rights and obligation. Contract assets, that entity right to receive a consideration has been as a contract asset other than for a consideration for a future performance. Contract liability, let's say I would received something in advance, then now I would define it as a contract liability. And I think that similar disclosure should also come in our financial statement. Earlier we were not showing, we were showing as a receivable or a liability. Now this terminology, if there are contract assets or contract liability, it has to be specifically coming in the schedules and notes, and one will also have to give a reconciliation of the contract assets and liabilities, which earlier we were either showing it or clubbing it in under some matters, but if it is related to IND AS 115, it has to be separately shown in the financial statements. Other is the customer. Customer is also, and in some of the matters it is very difficult to identify as to who is the customer. So here it clearly defines that a party that contracts with the entity for goods and services in exchange for a consideration. I think that is also very important thing which has been defined over in this standard. So yeah, key principles, if I would say under IND AS 115, it is lot many things are from a customer centric approach as to how the customer would, whether they would buy for a similar goods or services, how would you identify. So the focus is more on the customer as to how they would treat it, whether the performance obligation has been fulfilled, not fulfilled. I think all the definition is centered, which gives more a customer centric approach rather than entity. Performance obligation is also, which has been fairly defined, ESL I will take in the subsequent slides as to what are the subsequent performance obligation. It is one of the steps which needs to be determined, and based on that, the transaction price has to be allocated to each performance obligation. So whether it is a distinct performance obligation where all goods and services are distinct, or whether it is a single performance obligation and all the transaction price has to be allocated. This has a lot many impact on, I would say, a telecommunication company and an IT set of company which were largely offering a sort of a bundle contracts where the performance obligation were performed at a different points in time. Well, let's say I give a license and at the same time I give an AMC. So how would I bifurcate that two distinct set of obligation? I think the standard gives a more detailed guidance on that. Transfer of control is also one thing which was very much debated, and in this while doing a transition arrangement, transitioning from IND AS 11 and 18, this transfer of control, I think auditor would have faced a significant debate, because what would you constitute as a transfer of control? I think in earlier there were lot many guidance available. In earlier it was just like when the dispatch of goods happens from the factory, in case of a manufacturing, we would treat it as a revenue. But one will have to still determine whether the transfer or a control has been shifted to the customer or not. So there were a lot of debates happening whether FOB and CIF, in case of a CIF sale, should I postpone my revenue recognition till the point the buyer accepts the responsibility? And I think there were lot many controversy. I think still a balance call has been taken as to who during the transit bears the insurance, who bears the inventory risk, and based on that, so there are no right or wrong answer, but it all depends upon the facts and circumstances of each of your clients, and based on that you will have to determine whether the control has been shifted or transferred to customer or not. Variable consideration and time value 4 and 5, there was no guidance available under the earlier standard as to how would I adjust something where there is a variable consideration, where certain consideration will come based on certain events which would happen in the future. How would I account for it? So earlier the revenue recognition used to get postponed till the certainty or uncertainty gets resolved, but here there are guidance available as to how we can do it, especially in cases where there are discounts, volumes discount, trade discount, incentive, which earlier we were putting it as a part of an expense, but now under IND AS 115 it has to be get adjusted as a part of a revenue. So this is a one important change, and revenue being an important barometer for even the valuation aspects, this certainly would have an impact, because earlier you were putting it in an expense and we were showing the revenue at a gross level, but now if it is related to that, it has to be netted out against that transaction price. Last was a time value of money. So many contracts were such that the consideration used to come in a delayed manner, or there would be a contract that you pay it after 2 years. So under earlier standard there was no concept we would recognize entirely on the day one, in spite that the consideration would come at a later point in time. But under IND AS 115 you have to segregate the two. The interest component, which you will have to identify, the guidance is available as to how would you identify the interest component based on implicit interest rate, or how would you identify, and then you have to break it up, the total consideration price, into a cash selling price. Let's say if the customer today gives me a cash, how would I have treated a revenue? That would be your day one recognition, and the balance, the difference between the cash selling price and the agreed promise consideration would be treated as an interest. So this guidance has been given in IND AS 115, which were not in a fairly detailed manner under the erstwhile standards. So 115, I think, revolves around this 5-step model. If once you satisfy these steps of these all 5 steps, then only you would be in a position to recognize the revenue, and at each step you have to answer certain set of questions and answers, and based on that you may have to determine whether revenue can be recognized, what should be recognized, and when it should be recognized. So one is obviously the important parameter. First is identification of the contract with the customer. I think this is one of the most important thing which we need to determine. In some of the matters, it may be possible that you may not be able to identify a customer. Let's say one is doing an R&D contract where both of them are participating and creating, whereas one is taking the lead, and other, my joint venture party who is participating in my R&D, is contributing some to me, and I am doing my R&D in my lab. So the consideration which I am receiving from that co-development, he is not my customer, but he is a co-development. So identification of a customer needs to be established. Performance obligation, as we discussed, that whether it is a distinct or non-distinct goods and services, whether it is a combined contracts, whether it is a separate contract, how would a customer would treat it in such cases. Then determining the transaction price is another aspect where this variable, fixed, financial, significant financing component and non-cash consideration, if at all, has to be given effect to. Then allocate that transaction price to a different performance obligation, because if the performance obligation is performed at a different points in time, and if you are not in a position to decipher that, then you have to allocate the transaction price to a different performance obligation. Here also there are set of example as to how would you allocate. Let's say if I give a bundle contract, A, B and C contract, and if I say I am selling it standalone also, but if the customer wants all 3 from me, I would say that instead of 3 would have costed, let's say 1,50,000, I am giving it at, let's say, 1 lakh. And if all these 3 products, the performance obligation, are satisfied at different points in time, let's say A is happening in a year, month 1, product B is sold at on the 6th month, and at the product C is sold at 8th month, it should not be that the revenue recognition should be postponed to the 9th month just because I have done a bundled contract. I will have to allocate that transaction price to each of the performance obligation, and once I satisfy a particular performance obligation, I will have to recognize the revenue. And how to do it, I think the later part of the slides would cover that. And then recognize a revenue when the entity satisfy a performance. So after step 4, after determining a transaction price, the last step is recognizing the revenue. Here the question is whether you would put it in point in time or whether you would recognize over a period of time. And I think the most impact of this IND AS 115 was on a real estate transaction. Because earlier they were only following over a period of time method where they were allocating the revenue. But if the contract suggests that the control and everything is getting transferred only at the end, I would go to the criteria I have covered in my slide as to how the real estate transactions have been impacted. Still, many real estate companies are following two different sets of approach. I think time will tell as to which is the correct method. But yes, many real estate companies have also now a different kinds of contract also. Let's say subvention scheme, money to be given at the time of the possession. So based on each facts and circumstances, this has to be satisfied, whether it would be a point in time or whether the revenue can be recognized over a period of time. And I think the para 35 of IND AS 115, I would suggest go it in detail. Those all three steps, if one of the conditions is satisfied in that para 35, we can recognize over a period of time. But if one of the conditions are, if all of them or some of them are not getting satisfied, then we have to satisfy point in time, which I will show it in the form of a flow chart, how one can go about in recognizing the revenue. So yeah, contract recognition criteria. Yes, so the step 1 which talks about the contract, we'll have to see whether the contracts is approved by writing, orally, or whether there is a customary trade practices, whether the rights are identifiable, what are the payment terms has to be seen. The critical aspect is also with the standard says is about, in case of determining this, is the about a termination penalty. So if one of the party has a right to terminate unilaterally the wholly unperformed contract, then the contract is not identified and you cannot move to the next step of identification. So please have a careful look at the termination clause as to who can terminate the contract and when, and basis on that you determine the further steps in the 5-step model, whether it is a substantive penalty or how it is needs to be seen. It may also be possible that the contract term can also be a shorter if there are any significant termination clauses. So it may not be a 4-year contract, but if there are any termination clauses, then possibly the contract term may be a lesser than that. So do have a regard to that termination clause and the guidance given in IND AS 115, and then take a call whether further steps of revenue recognition can be taken up or not. Of course, one will have to see the commercial substance, whether the risk, timing and everything is getting transferred, and the collectibility. I think this is also one of the very vital thing, that whether whatever goods or services which you are offered, whether you would be in a position to collect the consideration. So I think that is also one of the important parameters which one will have to see. Let's say today, because of various economic condition and war-like situation in Lebanon and countries like that, if your client is selling the goods to a countries like Lebanon where there are lot many war-like situation, I think we need to determine whether that collectibility of the consideration would ever come into being or not. So such kind of a scenarios where the consideration collection becomes uncertain, one will have to have a very careful look. Though the contract may have commercial substance, everything, it would have been in writing, but if the collectibility is in question, then do have a look at this aspect, and then you cannot move to the further step, and hence the revenue cannot be recognized. Yeah. So second step, I think once it is determined that there is a contract, the collectibility and everything is certain, then one will have to move to a step 2, which is an identifying a performance obligation in the contract. So in identifying performance, I think there are 4 things which needs to be seen. Whether there are distinct goods and services, this means that the customer can benefit from the other resources which are available in the market or not, and to what extent there is a level of integration. If the level of there is a high level of integration which is required, then one will have to see whether those are distinct or non-distinct goods and services, or whether it has to be treated as a single performance obligation. I have covered in the examples, the case studies which I have covered in the at the end, where I think this would be fairly more clear. Whether there are separable promises, whether one can modify the goods and services, whether they can be customized, integrate with one another, also has to be seen, whether the performance obligation are distinct, non-distinct. Based on that, the transaction price. So performance obligation is very much required to allocate the transaction price to each of the performance obligation. So if it is a bundled contract, and if I am offering the services together, I will have to see whether those are distinct promises, whether those are separable promises, whether there are distinct goods and services, and based on that, the transaction price would have to be allocated. Another is a series of goods, distinct goods and services, which is largely in the case of a subscription kind of a services, where the distinct goods and services are offered over a period of time and which are substantially the same. If there are series of distinct goods and services, the revenue recognition can happen over a period of time. And some may be an implicit promises, like in case of a certain contracts, like in case of a maintenance or equipment manufacturing, where there would be an implicit promise that I would provide a maintenance for, let's say, certain period of years, then how should I allocate the revenue between the two is also one will have to determine. So yeah. Yeah, so it has to be because the performance obligation have to be performed over a period of time, it has to be spread over a period of 2 years. Nay, agreed, but see, it also depends upon what kind of contract it is. There are some license which is right to use license, which I have covered, or right to access the particular license. If it is a right to use a license, then if I am not performing any other obligation as such, then one can consider at a point in time. But if it is a right to access, let's say if someone is giving us services where even that entity which is offering the service is also continually making a changes in that, then one will have to recognize over a period of time, because even there will also be, one has to look at to matching principle also as to what services which even an obligation with the company has to provide over a period of time. Based on that, the call will have to be taken. This is a combined, the guidance is also been given about the combining of contracts, where if it should be negotiated as a single commercial objectives. If all these three questions are answered, that consideration of one contract is dependent upon the price and performance of another contract, and if the goods or promises are single performance obligation, if all these conditions are satisfied, then one will have to treat it as a single contract and not as a separate contract. Here also the standard also gives an example about what would happen if there are a contract modification. I have covered a case study, but just in the form of a flow chart I would try and explain how is it. So if both the conditions are satisfied, that if the scope of the modified contract is a different kind of a goods and services, consideration is also different, then account for that modification as a separate contract. So one will have to determine that whether that remaining goods and services, how far are they distinct. If they are distinct, then one will have to treat it as a termination of the old contract and treat it as a new contract. And if the remaining goods and services are not distinct, then one will have to do a cumulative catch-up adjustment, means whatever has been done so far, I will have to average it out and I will have to reverse or I would have to increase the revenue. So one will have to see and fit into this whether it is a contract modification which results in a different or a distinct goods and services which even the customer would have bought it from someone else would also have charged a similar, then I would have treated as a separate contract. But if it is just an extension of an earlier contract, and if there is some modification, let's have agreed to provide a certain services, but if the customer wants some more services, so I would give a certain discount on that because he is asking for a more services, then I would treat it as a contract modification, and whatever I would have earlier recognized the revenue at a higher rate, I will have to do a cumulative catch-up adjustment, and then I have to reverse an earlier revenue. So this guidance has been given in IND AS 115, which was not there in our earlier IND AS 18 and 11. Once an obligation and a performance obligations are identified, one will have to move to a step 3, which is determining the transaction price. So key changes which were there, which were not there, is, as I said, about a variable consideration, significant financing component, and a non-cash consideration. This one not dealt with in detail in the earlier standard, but here in IND AS 115 they are fairly explaining it in detail. So if you would have seen lot many annual report under a revenue recognition, they would have given a reconciliation for this. Do have a look I think you can have a look at TCS or even earlier other manufacturing company, where they would have given a reconciliation as to what was the contracted price and at what price I have recognized the revenue, which is the compulsory disclosure which is required under IND AS 115, which was not there earlier. And I think FRRB has, the Institute Financial and Reporting also releases its views on the disclosure. I think do have a look on ICI. I think they release it, I think every monthly on a Twitter of ICI FRRB, where all this disclosure, not just on IND AS 115, but which are the common pitfalls which the companies are not following and which is required as per the standard, they are rolling it out. So these were some of the concerns which they have raised, that reconciliation was not adequately given in the financial statement. So while doing an audit, if there is a difference between a contracted price and if let's say there are discounts, rebates, if there are financing element involved, even though my invoice would be let's say 120 rupees, but if it is receivable after 2 years, and if it is based on the discounting rate it is 100, I can recognize the revenue based on the discount rate at only at 100. So my revenue in the books would be at 100 and not 120. So reconciliation between 120 and 100 has to be given in the notes to accounts, that 120 was a contracted price less significant financing component 20, which would be recognized under IND AS 109, and the 100 which is matching with my revenue from operation. So all kind of reconciliation has to be given in the financial statement for all these 3 components. Non-cash consideration is something where there was absolutely no guidance earlier, but here it is saying that if there are any non-cash consideration, then it has to be valued at a fair value. So and if the fair value is not able to determine, then one will have to look into estimate it based on the standalone selling price of the goods and services provided in exchange, how it is used. So I think these are the 3 very important pillars which were not there in the earlier, but I think lot many details are given, and I think there are paras and guidance and material under this. So I think and all the scenarios have been considered, variable consideration in terms of incentive bonus, in case of a performance bonus which the company would be entitled to, how would I make an adjustment. There are methodologies which are prescribed, in variable consideration there are methods which are given as to expected value method or most likely not method. You will have to see where in your facts whether one will have to go as per expected value method, where range of outcomes are possible one will have to go for an expected value method, and it is if it is more like whether I will get it or not. Let's say if I complete a contract for my customer within 2 years, and if something is not in my control, then whether I would get it or not, it is more like a more than likely or not. So I will have to factor that. But if there are chances or where there are range of outcome possible, that there is a 20% likelihood that I would be in a position to complete that, then I will have to do a probability weightage and then recognize and consider that in a day one. But of course, lot many judgment and everything is involved. It is easier said than done. One will have to look into the past historical performance of the company, how in the past they have dealt with the variable consideration, and then basis that one will have to do a determination of a transaction price. This is also one of the concept which has been dealt with, whether one would treat it as a principal or whether one should treat it as an agent. This would have a very, very significant impact, because if you are a principal, the revenue has to be recognized on a gross basis, and if you are just an agent, if you are just a facilitator, then you would have to only recognize whatever fees or commission you are getting. So one will have to have a very careful look at the contract. Sometimes it may be structured in a way where company wants to show up a higher revenue and higher expense. They would treat it that I am a principal, but do have a careful look as to what they are performing within that, and then have a look. So there are criteria as to when one can be treated as a principal. So a principal can be treated when he has a responsibility of fulfilling the contract. He undertakes the responsibility of setting the price, and he has, if it is a manufacturer of goods and services, the principal should have a right and is bearing the inventory risk. If all these three conditions are satisfied, then one can treat it as a principal. But if I am just a facilitator of a transaction, just buying and selling, and I am not doing any particular, or I am just doing at the behest of my principal, and I am not putting any value addition to that, neither I can determine any price or nothing like that, then one will have to see whether it should be treated it as an agent. And of course, inventory risk is also very important criteria. Let's say even though I am buying and selling, but if I am bearing an inventory risk, I am bearing the market risk. Let's say if the goods does not get sold, I cannot go back to the principal to claim that loss. Then maybe I can treat it as a principal and record it on a gross basis, gross as a revenue and gross all the expenses. So this also, I think I have kept it on a very snapshot basis, but I think the guidance is available in the standard. Variable consideration I have dealt with in detail. As I said that it requires to estimate the variable consideration, and there are two methods which are prescribed. One is an expected value method to determine a variable consideration, and one is the most likely amount method. Depending upon how better you can predict the amount of consideration to which the entity is entitled. One, as I said, historical experience also needs to be seen before whether to recognize that revenue at the initial stage or not. So one will, and also the step one, whether I will be in a position to collect that consideration. So one will have to keep on checking all those 5 steps, whether all are fulfilled in toto, and then one can proceed towards revenue recognition. The standard also give a guidance on a constraining estimate. Let's say today I am unable to make an assessment whether I would be entitled or not, and this would be largely in case of matters where it is outside the control of both a customer as well as an entity. Let's say an asset management company would say that if the portfolio of that which the asset management company is managing increases by more than 20% based on the market price at that point in time, I would be entitled to a 20% more bonus. Now on the day of initial revenue recognition, I am not sure how the portfolio would move by the end of the year. So that would be a sort of a constraining estimates where at the initial juncture I am not able to determine my transaction price, and as a result I would wait till the time when the uncertainty is resolved. Till that time I will not recognize the revenue. This example also I have tried and covered. So I would break it up variable consideration into one is variable and fixed, estimate based on the expected and most likely, apply the constraint, determine the amount for which it is highly probable, so that you have to determine a probability in a way that significant reversal should not happen. So company as an auditor or from a company side, it is better to be a conservative rather than estimating anything very optimistic estimate and then you are unable to fulfill. So the standard has also given us a guidance that better to be a conservative, because they have specifically said that the probability of revenue not getting de-recognized should be significantly higher. To that extent only you will able to recognize a variable consideration, otherwise wait for the uncertainty to get resolved, and after considering this, whatever is the amount you determine in the amount of a transaction price. Time value of money, I think I explained, but just a reiteration of what has been. So there would be a contract where there would be a difference between a promised consideration and today's selling price. And the contract would also have been structured in a way because no entity would miss out on, because ultimately he has to bear a working capital interest for if he gets a delayed consideration from his customer. So in a way the customer is financing at the initial juncture. Only thing it is payable after, let's say, 2 years or more than a credit period. Then one would consider to bifurcate the transaction price based on the implicit discount rate which is there, and then break it up into the two and recognize that interest portion difference between a promised and an cash selling price. If the customer would have paid cash today, what would he would have paid? The difference between the two should have been shown as a revenue, as an interest income, and not under a revenue. So I think your revenue to that extent would be slightly going down because of this, because there is an element of a financing element which is structured in your contract. So these are the typically the customer financing where either customer is paying in advance or customer is paying in arrears. All this would be treated as an interest income and expense and not as a revenue. So one will have to, and this would again go under IND AS 109 and it would come out of IND AS 115 to the extent of interest income and expense. Someone would say that there are also exceptions to a significant financing where I am not required to do the difference between promised consideration and less as a significant financing component, where the customer has paid and the timing is at the discretion of the customer. So in that case, one need not recognize a significant financing component. It is based on an occurrence or a non-occurrence of a future event that is not within the control. In those scenarios, I need not consider a significant financing element. and the difference between the promise and cash selling are for the reasons other than provision of finance. Let's say there would be a certain kind of a contract where money has been withheld uh, just for an entity to see that whether whatever goods and services, or whether, and typically in case of an EPC contract where a customer would pay a consideration, let's say 25% after a period of 2 years based on the satisfaction of a performance obligation. So that kind of a delayed payment where an entity giving that is not giving it for a provision of finance, it is more towards a satisfaction of a performance obligation. To that extent, if the amount has been withheld, one need not make any adjustment for a significant financing. So need not be that all monies which are postponed or at a later date would all have an element of a finance. One will have to look into this particular exceptions to determine whether there is an financing component involved in my transaction price or not. Any questions? Once the transaction price has been determined, then I will have to allocate that transaction price to a performance obligation. So this would typically a case where I would be providing a performance obligation, and all those performance obligations are getting fulfilled at a different point in time. So how would I bifurcate that transaction price to different performance obligation? Because obviously some revenue has to be recognized because the company would have also have incurred some cost. Now if I satisfied certain performance obligation, I will not wait for all performance obligation to get completed to recognize my revenue. As and when I complete certain performance obligation, I would start recognizing the revenue. So this step gives a guidance as to how one can bifurcate the price. So there are three approaches which are given. It may also be possible, so the standard also says that, let's say if I have given a bundle contract A, B and C product, in if A, B and C are also independently sold, then I also have an observable market price or a list price for each of these A, B and C product or services. And if I have given it at a discount, I can apportion that discount in that particular proportion. So that observable market price is one of the most important thing to allocate the transaction price between all the performance obligations. But there may be a situation where certain products are not sold independently by an entity, it is always sold as a bundle. Now how would you bifurcate and how would you do it? The standard gives us three approaches. One is an adjusted market assessment approach, second is an expected cost plus margin approach, and the last is a residual approach, where in case of a residual approach where all the observable prices are available, and in case of a last product, if I am unable to determine, I will take a differential price. Again I will have to determine whether that differential price, let's say A, B, C, D product are there, and D product has been added and there is no observable market price or that, but how would a customer would pay for that price if he had bought from outside? And if it is lower than that, then there could be also an element of a discount, and that discount has to be allocated even on A, B and C product. So I think detailed guidance has been given on allocation of this in educational material. All examples, real life examples have been given. Some of them I have covered in my case studies, but just if you want to go in depth, do have a look at an educational material where they have given along with the calculations. So this is what I have mentioned, that there are three performance obligations. So first you have to determine a standalone price. first step, whether it is an observable standalone price available, then use an observable price. If observable price is not available, then I have to go with that three approaches, which is an adjusted market assessment, expected cost plus margin means cost incurred plus whatever margin which the generally entity always expects. Based on that, I will determine the standalone selling price, and then whatever has been a determined transaction price would be allocated between all these particular products. Now, if there are many products, how one would bifurcate the transaction price? So generally the transaction price would be allocated to a very single performance obligation if there are contingent payment which is related to that, and generally the entity expects to settle with that kind of a performance obligation. So that would be an allocation of a transaction price which would happen. And allocation of discount also has to be generally done proportionately, unless and until it is identified that it has to be done against one or more performance obligation. Otherwise, the general principle is that it has to be allocated against all performance obligations. After, I think that 4 steps which are satisfied, then the last step would be a recognizing a revenue, and I think this is slightly more critical, because how would I recognize?
Our chairman has come, so I would request our chairman to address.
Very sorry, Tejas sir. Very good afternoon, friends. It's indeed pleasure to be here with you all. I will not take your much time. I am here for some specific purpose. Let me first thanks to Tejas sir. Sir, thank you so much. Despite of your so much busy schedule and audit season, you are here and agreeing to share your valuable knowledge. Let me also thanks to the Nikita, the coordinator, and let me also recognize the presence of our Central Council member who is working day and night for the betterment of fraternity, Durgesh Kabra, and my regional council, young and energetic colleague, Rudesh Pankania. Friends, my just simple request to each one of you, we at WARC are continuously organize various seminar, webinar, and conferences in which we need more and more speakers, coordinator, and we can say some authors for our publications. And we also got mandate from our institute head office for some research paper. So this is my humble request. If you can go through our website and put your interest, if you wish to become either a speaker, or you wish to write some publications, or you wish to write in our newsletter, or you wish to become a coordinator, please do write us. It's our humble request. And friends, let me also share you that the expectation of our regulator and the stakeholders is very, very high from each one of us. So that's why we at WRC start Technical Tuesday, in which what we are doing in every Tuesday we are delivering, or we are arranging the seminar, either seminar or webinar on a technical subject like audit, IND AS, accounting standard, and all that. This is the initiative of our West India Regional Council. With this, I again thank you, Tejas bhai. Thank you so much.
Thank you, Chairman. I think you gave an idea about, I think, even I have attended few of Tuesdays, and I think it's in a capsule way, it helps a member to get an idea. I think last was on an audit documentation. I think it would have really helped participants in fulfilling their documentation requirement, and I think since the topic is the